situation where miners are leading the metals instead of following them reluctantly higher, which has been the case since I think the 2011 top, basically, more or less. There were instances where miners would lead, but they weren't sustained. I think now it will be sustained as we enter into a monetary financial crisis that could be triggered by Asia and the yen. Who knows what's going to happen in the banking system in the next few weeks and months. Stay put. I do believe we are very close to January 1979 when the previous triple top was broken out in silver, and then we headed within a year to $50. This could happen very quickly, and though we've been waiting for the beginning of it for many, many years, it is, I believe, imminent in the next few months.
In today's market recap, silver price recovers after testing $27 psychological level. Silver rebounds, rising 0.38% amid increased buying interest, remains bullish, trading between Fibonacci levels of 24.33 and 29.78. To gain further, needs to surpass 38.2% Fibonacci level at 27.70, targeting $28 and beyond. Silver price registers modest gains despite rising U.S. Treasury bond yields and a strong U.S. dollar. The gray metal dipped to $27 but climbed as buyers stepped in. Silver remains upward biased, and it remains trading within the 50% and 38.2% Fibonacci retracements drawn from the latest cycle low and high, each at 24.33 and 29.78, respectively. Now we'll show you the best clips of the latest Rick Rule interview. But first, smash the subscribe button, turn on notifications, and share this video with a silver bug. Enjoy the episode.
Dollar, it is weak against every Asian currency. The reason I focus on the yen so much is that it is a keystone of the entire global Keynesian system, which was set up between the United States and Japan after World War II, after Bretton Woods, and the Japanese became the most dedicated money printers and debt accumulators in the world relative to their economy. It's about like 265% or some insane number like that. So here you can see all of the Asian, not all the Asian currencies, but the major Asian currencies, the major trading partners of Japan in the Asian area. You can see it's at all-time lows relative to a lot of these currencies you have here: the Chinese yuan, the Korean won, the Thai baht, and the Philippine peso. When you have the Japanese currency at a low relative to all these other currencies, it really pressures the other economies to embark on competitive devaluations because it disturbs their trade balances, and then they get upset. And when you have competitive devaluations in an environment where consumer prices are already rising in all of these countries pretty fast, you have the recipe for really dying currencies, and Japan's currency is going to get a lot weaker pretty quickly, and you'll see why in a second. So you have here, this is snippets of an article from Bloomberg. This is not the title of the article, but I wanted to show here how Bloomberg is contradicting itself. So you have an idea of the dishonesty in financial reporting, and I'll follow this with some honesty so you can get some sense for what to look for here. So we have Asian financial crisis from competitive devaluation. This is Bloomberg writing about this. Suspected intervention to drag the yen off a 34-year low against the dollar is already seen as unlikely to have a lasting effect if Japan continues alone, raising this prospect of another bout of weakness in the beleaguered currency. That could push competitive tensions with exporting neighbors South Korea and Taiwan to a peak and heat pressure on China, where chatter is already growing about the potential for a yuan devaluation. So yeah, we're headed towards yuan devaluation. The point I wanted to emphasize in this article is that they're saying that Japan, the yen, is going to continue to weaken. There's not much that the Bank of Japan can do. But here, later in the article, this is not the next paragraph, this is lower in the article, it says, to be sure, there are signs that Japanese authorities may not allow the country's currency to slump further. So you have a complete contradiction between the first paragraph and that later paragraph. The reason I'm putting them back to back here is to show you the open contradiction here, which is not in the article. It just confuses you in the article. It says here, after falling below the psychological milestone of 160 per dollar for the first time in over 3 decades last week, 2 rounds of suspected official intervention have helped it stabilize at around the 155 level. I noted in the Endgame Investor on Substack that the Bank of Japan spent about $60 billion pushing the yen higher from 160 to 155 per dollar. And they did this by basically selling their dollar cash they have on their balance sheet and buying yen with it. That's basically all they do. They exist to buy yen and sell yen and manipulate currencies. That's why they exist.
But existing is basically all I do.
So on the one hand, the Bank of Japan can do nothing. On the other hand, they may not allow the Japanese yen to fall below 160. And here it says in this paragraph, a yen slump to the 170 to 180 per dollar level could not only cause problems for Asia, but also impact emerging market currencies more broadly. That's in large part due to the yen's role as a funding currency for carry traders who borrow where rates are low and invest in developing nations where they are high. The final quote here is important because we are in an environment where it's hard to see why treasuries would rally, but here is the reason why they would briefly rally in a little bit of an earthquake out of Asia. It says here, if Asian currencies devalue because of the strong dollar, the funds that invest in local markets will have to pull out. He said the whole EM market will crash, and that's going to cause a risk-off event where treasuries will rally and equities will sell off. This again contradicts what it said earlier in the article that a financial crisis will not repeat itself in Asia. There's going to be no repeat of 1998, but here it says the whole EM market will crash. Another contradiction. These articles make absolutely no sense, and they just kind of spitfire different positions at you, but don't weigh them, and they're just kind of like put together by AI, it seems. Okay, so here I wanted to go into an instance of actual journalistic integrity of Axios versus CNBC. So this on the right is CNBC talking about the deal in FTX, the crypto exchange that went kaput a few months ago. Was it a year ago already? I don't remember. So it says here, FTX says most customers of the bankrupt crypto exchange will get all their money back. That sounds great.
In the latest financial forecast, Rafi Farber predicts a significant spike in silver prices, suggesting they could potentially reach as high as $231. This bold projection is rooted in a comparative analysis with the 1970s silver market, applying a multiplier of 4.62 to the historical peak price of $6.50. The validity of this forecast hinges on a stable economic environment and assumes no additional monetary expansion by the Federal Reserve, a somewhat optimistic scenario given current trends. Further afield, Farber highlights increasing concerns around currency stability in Asia, particularly with the Japanese yen. A weakening yen threatens to disrupt trade balances and could prompt a chain reaction of competitive currency devaluations among Asian nations. This scenario poses a risk of accelerating inflation across the region, complicating the economic landscape further. Meanwhile, the mining sector, led by entities like Fortuna Silver Mines, is on the brink of a breakout. This anticipated shift in the mining stocks could potentially set a new trajectory for the precious metals market, with silver and gold possibly entering a sustained bull phase.
So it begins by saying this: almost all customers of collapsed cryptocurrency exchange FTX will get their money back and more, according to a court filing. Well, that's wonderful. And then it gives you a sum of the cash they have on hand, about $11.2 billion. That's amazing. So customers will get $50,000, with $50,000 or less will receive 118%. Keeps going on how great this deal is. And then later in the article, this is later, it's not immediately after this, it says, accordingly, the debtors have not been able to benefit from the appreciation of these missing tokens during the Chapter 11 cases. So basically that means that they will get the dollar amount that they had in their account when their cryptocurrencies were stolen by Sam Bankman-Fried and company, but they will not get the appreciation that would have accrued had they still had that Bitcoin. But it only says this in quoting a press release and wants to emphasize how great the deal is, where they're getting their dollars back, but not their assets back that were stolen from them. But here, Axios is actually a lot more honest and emphasizes what you need to know here. So it says FTX plans to repay customers in full, quotation marks. Here's why they still lose. So it says here in the first sentence, FTX took a significant step in its bankruptcy case following a reorganization plan that touts to repay customers in full plus interest. Why it matters: customers still don't stand to recover what they lost in the cryptocurrency collapse. Between the lines, bankruptcy lawyers for FTX announced a plan Tuesday night in which customers with $50,000 or less worth of assets on the platform, which is about 98% of users, would get 180% of the value of their assets. But if someone had a Bitcoin and FTX at that time, it was worth $18,562, and now it's worth, what is it, $62,000. So the recovery plan is about equivalent to a Bitcoin price of $21,903. They're losing about they're getting about 33% on the dollar or on the Bitcoin. So you have perfect example here of honest reporting by Axios versus dishonest reporting by CNBC. If there is honesty anywhere in the mainstream media, that's a good sign. I don't know if it's a trend. I don't know if this is just crypto enthusiasts being honest because they're enthusiastic about crypto or whatever it is, but it's an important example. Now I wanted to get into silver. This is the silver report, of course, and I saw something pretty exciting going on in the technical action here. I've shown this chart before. I wanted to get through it through another angle here. This is not a contiguous chart. You see here on the left side, you have January 1974. On the right side, you have January 1978. So there is a gap here that I'm not showing, but I wanted to zoom in and show the triple top here that happened in the 1970s and compare it to what's happening now. So we see here in 1974, silver had a parabolic top of $6.50. We repeated very closely that top here in May of 1974. So this is the equivalent of August 2020 and then February 2021 silver squeeze top, where we got very close to the second top here. And finally in 1978, January 1978, 4 years later, 4.5 years later, actually, because this is February and this is November, almost 5 years later, we had the final triple top at $6.50, almost exactly. It's a very near perfect chart here, and now I want to show you what's going on today. So we have 2020 to 2024. This is a very, not exactly equivalent, but there is no exact equivalence in technical analysis here. I just wanted to show you this and then compare it to the CPI when I came up with something pretty fascinating. So we have here the triple top. Here is the 1974 equivalent. Here is the later 1974 equivalent. And here is the November 1978 equivalent at $30. Same triple top. Now, usually in triple tops, if the triple top holds, you have a collapse in asset price. I do not think that's going to happen now. I think we're going to break through that triple top just like we did in only 1979. Now note here, the top at $30, and note back there, the top at 6.5 at $6.50. Now, what does that remind you of? Here I did the math. So we have $6.50 top in the 1970s versus a $30 top now in silver. Sound familiar? Indeed it does, because if we take $30 divided by $6.50, $6.50. I don't know why I keep saying that. The ratio is 4.62. And now I know that the CPI is bull. I get it. But it doesn't mean that it's completely invalid. There is some information being relayed in the CPI. Interestingly here, we have the CPI of November 1978, when that triple top was hit, was 67.4. And the CPI now, if you look over here, in this red box, 312.332. Now you take 312.33 divided by 67.4, you have the ratio of the increase in the CPI factor. That's 4.63. Same number, almost exact same number as the difference in the ratio of the silver top, $30 now, $6.50 then, 4.62. Now, if silver had a top of $50 in 1980, just after it broke through this triple top, about a year after it broke the triple top at 6.5, then $50 times the multiple of 4.62 would be a top of $231, assuming the Fed doesn't print any more money at all. Of course it will. So if we're looking for $50 silver, we're looking for a $231 top, and it is looking very much like we are in the late 1970s, close to 1979 now in silver, and silver is just starting now to get moving. Once we hit 30 and rise above it, we will be in space. Who knows how high we can get, and the panic should be very soon after that in real money terms. The last thing I wanted to show is that we have what looks like an imminent miners breakout in mining stocks, and of course FSM, Fortuna Silver Mines, is participating in this. This is the triangle trend line from 2011, the all-time high in mining stocks. This is the Huey Gold Bugs Index. I'm going to show two indices here. We have the top here in September 2011 at about 570. We have here a trend line established in 2020, hit again in 2022, and we're just below it here. We're at this resistance over here at about, what is it, 270 or whatever it is. and miners did very well yesterday. So once we break through this resistance, we have to break through this triangle trend line, and then we should be off to the races, going back to 2012, where this precipitous collapse began a humongous bear market, which we are still struggling to get out of if you're counting it by old highs. Zoom in here, how close we are to this triangle. This is the same triangle zooming in from 2020 on a 5-year chart. So we have here a touch, and here we're just pinned below this resistance. We're going to break through it maybe in the next few days, maybe in the next few weeks, but pretty soon. And once we hit something around 290, we should be out of this triangle formation and off to the races. GDX is even closer, and I think GDX is a little bit more valid than the Huey because you can't really buy the Huey, it's just an index. The GDX is actually an ETF that people buy and sell, so I would say it's slightly more accurate when it's reflective of buyer conditions or seller conditions, market conditions basically. So we have the top here in 2011 in the GDX, and a touch here, and we're very, very close. The triangle trend line looks to be at around 36 or so, and we could break through that any day. We'll see what happens. If we zoom in, yeah, it's about 36, just above 36 here, and the further we go out, the lower it will be. So I'd say once we break through 36, we are through this triangle and off to the races on miners. And
what do you think of Rafi's take? Is there a looming crisis ahead of US? Will gold and silver shine in that scenario, or will precious metals continue to be range bound? Share your insights in the comment section down below and watch this video right here because it's a perfect fit for you. I see you on the other side.